terms of what will decide where we go?
Yep. Thanks, Oliver. Thanks so much for your time today. Yeah, generally speaking, it seems like from a virus trend perspective, in the U.S., we're starting to see early signs that we're perhaps peaking here. In fact, if you look at the IHME models that are used by the administration, the U.S. cases may actually be peaking or have peaked on April 11th. The number of deaths projected by the model is now about 61,000, far below the initial 100,000 to 200,000 estimates we saw. Importantly, New York, which had become the epicenter of the crisis in the U.S., is now expected to have peaked on April 8th. And we're already showing early signs of plateauing. You know, we've seen the number of intubations, the number of hospitalizations, and the number of ICU admissions all come down this weekend. Importantly, though, you know, as we talk about a potential reopening of the economy, it's important to note that until we really have a vaccination in place, which could be not for another 18 to 24 months, we're really facing potential for a second wave of infections, particularly as we hit the fall season. So we really have to think about this in a smart and really steady, gradual way. So that's what we're looking at now from a virus perspective. You know, from an economic perspective, while the virus may be peaking, the economic crisis seems to just kind of be beginning. We're seeing that clearly from a jobless claims perspective. Last week, we got another 6.6 million in jobless claims, again, above forecast. That comes on top of the 6.6 and 3.3 million from the prior 2 weeks, likely bringing the unemployment rate here in the U.S. close to 14%. Now, we expect that jobless claim figure to plateau over time, but unemployment in the U.S. could reach 15 to 20% by the end of this month alone. Now, keep in mind, the U.S. hasn't seen unemployment figures like that really since the Depression era in the late 1930s and 1940s. So when we ultimately do reopen, it's going to be challenging for consumption to resume as it really had pre-crisis, because it'll be hard for those who are unemployed to find a new job right away. And then, of course, the overall consumption levels may remain depressed and cautious once we reemerge. But we're clearly seeing, you know, stimulus, massive stimulus in both the Fed and the federal government that could offset some of this pain, which is what's being reflected in the market today. But happy to pause there.
When we see the move that the market now has made, Mona, and trying to assess what it means, there's a few different schools of thought that I can see people offering. One is that it's just most markets and stocks doing strange things, looking forward very, very far. The other explanation is that the market here is moving to try and assess basically what the better than expected virus outlook means for the economic data. If the virus is causing the economic fallout, and that's moving a lot better than some of the worst expectations, should we then expect the economic data to also move faster than the worst expectations in terms of rebounding, or the two not connected as directly?
Well, you know, it's not really the virus that's causing the economic fallout. You know, the number of people that are unfortunately sick or have even passed are not really where the economic damage is coming. It's really the shutdowns and the quarantine.
Right.
Currently, we've had 42 states, over 90% of the U.S. population under lockdown. Until that starts to come back online in a reasonable fashion, it will be hard to see the economic data stabilize. What we are seeing, though, from a market perspective, there are some early signs of market stabilization, especially after that sharp drawdown we saw last month. I know your earlier guest had talked about the VIX, but the VIX, or that fear index, has really come down from peak levels, now in the 40s versus its March high of 83. We've really also seen a sector rotation out of some of the more defensive bond proxy type sectors like utilities and REITs, and into more growth areas like tech and healthcare. And then, of course, spreads on both investment grade and high yield corporate bonds have tightened from recent widening spikes. So that's been supported by massive Fed stimulus as well. All of these factors, we think, may be part of a bottoming process here, especially in equities, where perhaps the large part of the down move may be behind us. But, our analysis also shows that markets tend to bottom after about 65% of the recessionary period has passed. So we continue to believe that between now and perhaps the June time period, we will go through a bottoming process, perhaps not retest those lows as some had thought earlier, given the amount of stimulus that's come fast and furious in this crisis. But we will have opportunities between now and June where we really can position our portfolios nicely for a post-COVID-19 world.
This is, I think, a really interesting point, and one that is difficult but crucial to talk about, Mona, which is whether or not the historical sort of playbook and precedent works when not only did the market itself fall so quickly, but the response by the government also happened so quickly. We pretty much had a couple trillion under our belt before the first jobless print even came in. So do we need to go through this long, troughing, brutal period if the response is one that was basically there upon arrival? I mean, we showing up to this kind of forest fire in the economy with the whole line of fire trucks and gear so that we can get through it? I mean, is that a recession that will cause the kind of historical expectations? I mean, if we're there, but we've got all the gear we need to get through it, then what's the recession really even mean?
Yeah, no, it's a great point. You know, if you think about a $20 trillion economy roughly here in the U.S., on a quarterly basis, we produce about $5 trillion roughly in output. And the Fed and fiscal stimulus has now amounted to about $7 or $8 trillion, 40% of GDP, more than enough to cover, you know, the quarter or so that we may be offline. The real issue will come, obviously, if this is protracted in any way. If we start to get a second wave of infections, perhaps come fall, and we have to shut down again, et cetera, et cetera. You know, we're seeing some signs of that across the globe, with Singapore having to reinstitute shutdowns in their economy. So there is a risk that this does become longer than many expect. And I think that's the downside risk. But barring that, and, you know, assuming that perhaps we do get a therapy or even a vaccination earlier than expected, I think there's actually upside risk in that scenario. So when we think about positioning, you know, what we tell investors is perhaps think of a barbell approach for your risk assets. You know, on one hand of that barbell, continue to remain somewhat defensive. Assets like treasuries, gold, the U.S. dollar, and even some high-quality investment-grade bonds make sense. But on the other hand of that barbell, start thinking about the risk exposure you want for this post-COVID-19 world. Areas like, for example, food services and online retail delivery probably continue to do well. Many technology trends continuing to have a secular up theme, Wi-Fi and 5G, the whole e-gaming, video conferencing, remote education space. And then, of course, companies will need cloud computing and enhanced cybersecurity solutions. We also continue to see innovations in healthcare occurring, not only from telemedicine, but also from pharmaceutical players. And then we think about certain market dislocations here, you know, those assets that have been priced to distress levels, for example, airlines, some sort parts of energy, but perhaps will survive through this, could be interesting as well. So overall, we kind of continue to believe active management is probably a must as we navigate this crisis, because there will be winners and losers. There will be defaulters at the end of this. But overall, we continue to believe that longer term, the health of the U.S. economy is not derailed fundamentally. Society will move forward, albeit with much more caution around health and safety. But when we do stabilize, you know, we're in an environment where many of us had been waiting for more attractive risk-reward opportunities. So that's kind of how we're thinking about the world today.